Hi class, welcome to another video. This video is specifically for calculating cost of goods sold and ending inventory under the periodic inventory system. So we have periodic and perpetual. This is just periodic. We'll use examples with FIFO, LIFO, and weighted average, so all three of these. A periodic inventory system adjusts inventory and records cost of goods sold, COGS, only at the end of the reporting period. The system is simpler to use than the perpetual and less costly to implement during the period, but usually requires a physical count before ending inventory or cost of goods sold can be determined. We calculate cost of goods sold by adding beginning inventory to net purchases, then we subtract ending inventory. Keep in mind that the periodic inventory system debits purchases instead of that inventory account as seen in the perpetual. So let's go take a look at an example. So Smithson Corporation uses periodic inventory system. Following information related to merchandise inventory during the month of August, year one is available. So this is what we have on hand. We purchase some at this amount. It's in all chronological order. So on the 14th, we sold this amount for $12.07, purchased more, $5.67, sold for this, and here's the inventory on hand units, and this will be important. So here's what's on hand in the beginning, this is ending, purchase, sold. So we need to determine the inventory balance for August 3rd, 31st, year one, the balance sheet for what's the ending inventory, and the cost of goods sold that will appear in the income statement. So we're going to do this under the FIFO, first in, first out, LIFO, last in, last out, and the average cost. Okay, same information that was on the previous slide. So what we're going to do is we're going to have three columns: available for sale, cost of goods sold, and ending inventory. So here we go. We have available for sale. So as of August 1st, right here, inventory on hand, it's going to be 2,900 units at $7.18 a piece, and that totals to 20,822. Remember, we're looking to calculate available for sale. August 8th, this is purchased, so we should have 10,005 for 571, which totals to 59,955. Next available for sale should be the purchased on the 18th. For 6,400 units at 567 for 36,288. So we're going to total this. This is total units available for sale, and this is the actual dollar amount available for sale. So next we'll have cost of goods sold, then we'll have ending inventory. The cost of goods sold. So we're going to use first in, first out here. So when we sell it, we're going to sell these first. So if we sell more than 2,900 units, we're going to go to the next quote layer or next purchase. And down here will be the ending inventory starting that way. So first in, first out, it measures the income statement on when we sell something, and when we sell something, we count for cost of goods sold. Again, periodic FIFO, disregard that. This PowerPoint might be a little off. So we are not going to worry about what we sold the units at. So that's going to be crossed out. So don't worry about that. That's actually confusing. That's more sales revenue. So first in, first out, these numbers 2,900 and 10.5. First in was this at 2,900. So 2,900 units are going to be recorded. We need 16,300. So we get 2,900 from here. We get 10.5 from the next purchase. Remember, first in, first out. There's the first in, this is the next one in, and this is the next one in, 6,400 units. But we didn't need the whole 64 units because we had 12,400, and how we get 2,900 is we just take 16,300 minus 2,900 minus 10,500, and we only need 2,900 out of that. So let's bring these numbers across. So 2,900 units at 718 equals 2822. The 10,500 units should be 571. That equals 59,995. And the 29 units we took out of the 6,400 units, again, we didn't need all these because we just needed 16,3, should be 567. And that totals to 16,443. Total units, disregard that one. Oh, I guess it goes, I'll explain that. Total units should be 97,220. And honestly, we can actually calculate this since we already have the available for sale and the cost of goods sold. Once you have two, you subtract this from that, and you'll get this. And if we went and did ending inventory first, we can subtract the ending inventory from the available for sale to get cost of goods sold. But we can go through these anyway. Ending inventory, 3,500 units. We know that because 3,500 units are here on hand. So if we take 3,500 units and add what we sold, should equal the available for sale. So let's check this down here. Here's a little diagram to show the FIFO for beginning inventory, purchases, cost of goods available for sale, less ending inventory equals cost of goods sold. So this is the actual calculation to calculate cost of goods sold. So the beginning inventory is 20,822, and this is what we get up here, inventory on hand. So when we multiply this by that, we get that. Purchases, there were two purchases, right? So we purchased here and we purchased on the 8th and the 18th, and here's the 8th and the 18th, and here's the totals. That will include purchases, and our available for sale should be the 117,065. We subtract our ending inventory and we get our cost of goods sold. That's the FIFO method. So let's check it. Let's check out periodic LIFO. Same information. The available for sale is going to be the same. The cost of goods sold is still the same, 16,300 units that we sold, but we're just going to account for it LIFO. So last in, first out. And we get 3,500 because we already know these two numbers. Once you know these two numbers, the ending inventory is the difference. So available for sale, it can only be one of two things: cost of goods sold, ending inventory. That's it. So we take last in, first out. So the last in was purchased at 6,400 units, and we're gonna multiply that by 567. We need 16,300. So we got 6,400 there. We take 9,900 out of the 10,500 because this will be the next one. So LIFO, last in, first out. The last in was this, and the next was this. We do not need the whole 10,500 here. We're only going to take 9,900 because that 9,900 plus 6,400 equals 16,300. So the ending inventory is going to be 600 and 2,900. How do we get that? Ending inventory. So think about it this way: the cost of goods sold is the part that has either LIFO or FIFO. We measure the cost of goods sold. So we measured kind of, I don't want to say it this way, but up, right? So last in, first out. So the ending inventory is going to be here, then go down. So we have 2,900 here, and we're going to take 600 from this because we only need 3,500. Again, the PowerPoint is a little off, so we're just bringing these balances over. The 6,400 at 567, the 9,900 from the 10,500, that's all we needed for the cost of goods sold, was 571. And here's the totals. 2,900 at 718, the 600 at 571. Here's our totals, and there's our totals. So again, if we didn't have that, we would just take this minus that, and it'll give us this. So next, LIFO. This is a good representation of side by side. The beginning inventory and the purchases and the cost of goods available for sale will be the same always, regardless. The only difference is how we value ending inventory and cost of goods sold. So our cost of goods sold, our ending inventory, we know here. So, and we actually have the cost of goods sold here. This is more of a checkpoint. So basically the 117 minus the 24, 248, the same thing as 117 minus that. So this should be 92,817. The cost of goods sold is actually lower than FIFO. Interesting. So usually in rising prices, so it's not rising prices, actually inventory in hand, and that's actually lowering prices. That's kind of weird. So in this situation, LIFO is going to give you a higher net income because the cost of goods sold is lower. Interesting. So keep in mind, usually FIFO gives you the higher inventory balance and the higher cost of goods sold because of prices are rising. In this situation, it's actually lowered. So keep that in mind. Average cost. Average cost, it's going to be a lot easier. So we're just going to use this information. Pay attention to 19.8 and 11, 117,065. We're going to take the cost available for sale value of 117 and divide it by the 19.8, and we get a cost per unit. So the cost per unit is $5.91. So the good check there is 19.8 times 591 equals 117. 16.3 times 591 is your cost of goods sold, which is 96, and 3,500 times 591 is your ending balance inventory of 2,693. Stack that up to each other. Again, these are going to all be the same, and this is going to be, actually this would probably look better in the middle because that's where it really represents. But the cost of goods sold is actually the highest for average inventory, because you'll have some discrepancies here because we usually have these problems with rising prices. But this is actually a good example of looking at an actual real world example when prices can go down. So let me see. So let me know if you have any questions on that, and I'll certainly answer that in class. And thanks for watching.